If you want to retire early, you need to stop putting your money into 3 investments. And at least one of them is probably in your portfolio right now. I retired at 48, and that was 3 years ago, and I live off of my investments. None of these 3 ever made the cut. And the part that surprises people, the #1 retirement killer on the list is the one that advisors call the safe choice. I'll also show you what the research says works instead. And just by plugging in one of these leaks can be worth $500,000 over 20 years. Plus the one thing that I look at every week now that I'm in my 50s. And stick around, because at the end, I've got a 1-page worksheet that takes your risk level, what you've got invested, and what you add every month, and matches it to a strategy. It's free, and I'll show you where to grab it. Real quick, welcome. My name is Emilio, and this channel is about one thing: helping you retire sooner so you can live the life you actually want. Do me a quick favor and tap that like and subscribe, and let's get into it. Now, before I name the 3 investments, I want to make you a promise. For the next few minutes, I'm going to assume nobody has ever explained any of this in plain English to you. No jargon without a definition. No chart without an explanation. And if you've ever bought an investment in your life, you're in exactly the right place. And if you already know your way around this stuff, stay with me anyways. The foundation takes about 3 minutes. And the #1 item on this list is the one that catches people who've been investing for decades. Their advisors put them there. There are 5 words that unlock the entire video: investment, fund index, compounding, and inflation. That's it. Learn these 5, and everything I show you today will make sense, including the twist at #1. Word 1, investment. An investment is anything you can buy because you expected it to grow in value or pay you in money while you own it. A piece of a company, a building that collects rent. You're trading money today for something that should hand you back more money later. And what it hands you back each year, measured as a percent, is called your return. Word 2, fund. A fund is a basket. Instead of picking one company and hoping, a fund pools money from thousands of people and buys a whole collection of investments at once. You buy one thing, and inside it, there might be 500 companies. Keep this one close, because every trap in this video is a specific kind of basket. Word 3, index. An index is just a list. The S&P 500, for example, is a list of 500 biggest companies in America. So an index fund is a basket that simply buys everything on the list. No opinions, no guessing which company wins. It owns all of them, and it rides the whole market up and down. Word 4, compounding. Compounding is growth on top of growth. Your money earns a return, and then next year, those earnings start earning their own return. Early on, it looks like nothing. Give it 20 or 30 years, and it's doing most of the work in your retirement, which also means anything that quietly skims from it does most of the damage. Remember that. It comes back at trap #2. Let me make compounding real, because it's the engine that everything else in the video either feeds off or drains. Say you put in $10,000 and it grows at 7% a year. In roughly 10 years, it's $20,000. 10 more years, $40,000. 10 more on top of that, you added nothing along the way, and doubling did all of it. That's why time is the biggest advantage you have, and why anything that slows the doubling costs far more than it looks. And word 5, inflation. Prices creep over time, so the same dollar buys a little less every year. In any single year, you barely feel it. But think about what a week of groceries cost you 20 years ago versus today. Stretch that over 20 or 30 years of retirement, and inflation can cut what your money buys roughly in half. Hold on to that one. It's the entire story behind the #1 trap. That's the ladder: investment, fund, index, compounding, and inflation. Now here's the picture I want in your head for the rest of the video. Your retirement savings are a water tank. Compounding is the tap, slowly filling it year after year. And each of these 3 investments that I'm about to show you is a leak, not a burst pipe. You'd notice a burst pipe, a slow leak hidden behind a wall, draining the tank for decades while everything looks fine from the outside. Let's start with leak #1. It's the one you probably expect: trendy funds. These are baskets built around whatever story is exciting right now. Artificial intelligence, clean energy funds, space funds, you name it. The industry calls them thematic funds, which just means a fund with a theme. And every one of them comes with a story about the future, and the story is usually even true. That's what makes them dangerous. Nobody buys a bad story. Artificial intelligence really is changing the world. Clean energy really is growing. So when your brother-in-law tells you about his fund doubling, it doesn't feel like gambling. It feels obvious. And I'm not lecturing from a mountaintop here. I fell for it myself. I bought Bitcoin and a pile of other cryptocurrencies because everybody around me was hyping them. At first it worked, and that's the trap. It usually works at first because everybody bought in when the crowd was still arriving. Then it tanked and the story didn't change, the price did. And with thematic funds, nobody has to guess how the story ends. Morningstar, one of the biggest independent firms that studies funds for a living, tracked them over 15 years. More than half of them didn't even survive. Not underperformed a little, gone, closed. And the ones that did survive, fewer than 1 in 5 beat the plain global market, meaning that you had done better owning the boring list of everything. But this is the part that should stop you cold. Over one 5-year stretch, these funds returned about 7.3% a year. The people that invested in them early earned about 2.4%. Same funds, same years. And how is that possible? That's timing. A trendy fund only becomes trendy after it's already gone up. That's what puts it on the news. So most people pile in at the peak of the hype, write it down, get discouraged, and sell near the bottom. The fund's chart looks fine. Your money bought high and sold low. The fund can win and you can still lose. That gap between what the fund earns and what the investor actually takes home is so common, the research world gave it a name, the behavior gap. File that one away too, because later I'll show you the simplest thing that closes that gap. Before we move on, here's your move for this one, and you can do it tonight. Open up your investment accounts and read the names of the funds you own. If the name is selling a story, intelligence, innovation, energy, future, anything that sounds like a headline, that's a thematic fund. All right, let me show you now. This is a public fund screener. Your brokerage has one built in. It's free to use. This one in particular is stockanalysis.com/ETF, as you see here. So we're gonna go through a couple here just to give you a show of these innovative, thematic, AI type. Now, ABOT right here, you see the name innovation in there. It's not a big one, 5 million invested. Let's look for an AI one. AIQ here, you see like it's a big fund, $10.5 billion. You see in the name, global artificial intelligence and technology. That's telling a story through just the name. And that's without even looking at the numbers yet. Now let's look a little bit deeper at a couple and the numbers. See ARC Innovation ETF here. So this one has $8 billion in assets. But the most important part here is the expense ratio. And that's almost 1% on this one. And there's higher ones, and then there's the boring ones. This is the total market, basically all the stocks in the market. And as you see, the expense ratio is closer to that 0.25%. That's a huge difference, 0.25 to 1%. And that's the whole scan. I'm not trying to sell you on anything yet. Step 1 is knowing the leak exists. Leak number 2 is the one your parents trusted, the actively managed fund. Let me define it, because the name hides the game. Remember, an index fund just buys the list, no opinions. An actively managed fund is the opposite. A professional stock picker actively chooses what to buy and sell, trying to beat the list. There's a track record, a glossy brochure, a manager in a nice suit. You'd think paying a professional would at least buy you average. Here's a scorecard. There's a long-running industry study called SPIVA, whose job is comparing active funds to their index. Think of it as a league table for the professional money managers. Over 20 years, about 92% of the active US stock funds lost to their own index. Not to some genius rival, to the plain list they were hired to beat. And over 15 years, there wasn't a single fund category where most of the managers came out ahead. 9 of 10 professionals losing to a list, and you're paying them real money for it. Which brings us to fees. And I want to slow way down here, because this is where the leak quietly drains more than most people lose in a crash. Every fund charges a yearly fee, taken straight out of the money, whether the fund wins or loses. It's called an expense ratio, and it's written as a percentage. A plain index fund costs around 0.05 of 1% a year. On $100, that's 5 cents. Almost nothing, because there's no team of stock pickers to pay. A typical active fund charges around 1% a year, 20 times more. Hire a financial advisor to manage the account and their fees stack on top. Now you're nearing 2%. Then there are variable annuities, an insurance contract wrapped around investments sold with add-on features called riders, where the stacked fees can pass 3% a year. And some mutual funds charge what's called a front load, nearly 6% skimmed off the top before a single dollar of yours is even invested. Now, 1%, Sounds tiny, right? It isn't. And compounding is the reason. Your money earns and your earnings earn. Fees compound the same way, just against you. Every dollar a fee takes this year was a dollar that would have been earned on its own return next year and the year after for decades. You don't just lose the fee, you lose everything that fee would have grown into. So let's watch it happen with real numbers. Say you've got $200,000 invested. You add $1,000 a month and you give it 20 years. The market pays everyone the same 7%. The only difference between the 4 people in the picture is the fee. The index investor paying 0.05% ends up around $1.3 million. The 1% active fund lands around $1.1 million. Nearly 200,000 is gone. The 2% fund plus advisor, about 950,000. And the 3% annuity, a little over 800,000. The exact same market, the exact same deposit every month, and the 3% product takes about $500,000 off of it. $500,000. And no statement ever shows it to you. It's just leaked. One quiet percentage at a time. Don't take my word for the numbers that I'm giving you. This $500,000, let's run it together right now on this government website I have here, investor.gov. It belongs to the SEC, the regulator for investments, securities and exchange commission. That's a free calculator. There's no sign up and no sales. Now we're gonna show you initial investment, 200,000. Monthly contribution, 1,000. Giving $1,000 a month for an example. And we're just going to use 20 years. Now, if the market pays you 7%, let's just use that as an example. So there's nothing here for fees, but let's say you're doing an index fund and they have 0.25%. So we'll just put 6.75. So once we calculate that, we'll see that's 1.2 something $1 million. You see this nice chart here. Now, same person, same deposits, same 200,000, 1,000 a month for 20 years. And let's say they have that 1% off. That's 6 instead of 7. We calculate that. And that's 1.082. So that's over $200,000. Let's say we have 3 now, percent off from the 7. Then we have 4%. Calculate that, that's a little bit under 800,000. That's a $500,000 difference. The fee took about roughly $500,000. You don't have to trust these numbers. Just try yourself on the same website. I'm gonna have all these in the notes, in the description, and you can try it tonight. And for a lot of people, that's the entire difference between retiring in your 50s and working into your late 60s. Your move on this one takes 2 minutes. Search the name of any fund you own plus the words expense ratio. Every fund is required to publish it. Down near 0.1% and you're fine. Above 1%, you've found a leak. And if you work with an advisor, ask the one question they should answer in a single sentence. How do you get paid? Here's a 2-minute move in real time. We're gonna look at the expense ratios and I'm gonna show you how you can find them quickly, whichever one it is. But let me just show you. Remember the crypto story I told you about? Well, take the best well-known Bitcoin crypto fund and type it into Google here. So its symbol is GPTC and I'm gonna just say expense ratio. Now here you're going to see it's called the Grayscale Bitcoin, the Grayscale Bitcoin Trust Fund. And it has a expense ratio of, and a little bit of a explanation about the management fee being deducted directly from the fund's assets to cover operational costs. Now we're going to get to one of the boring ones. So let's say you have a index fund and this one is a Vanguard 500 index fund. So I'm just going to say Vanguard 500. Index fund. That's from the S&P 500. And I'm just going to say expense ratio. As you see here, it's closer to, that's 30 to 40 cents per thousand. Nearly 40 times cheaper than the last one we were looking at that had 1.5. And that's the whole check. 2 searches and you see exactly what you're paying for and who's getting paid. Quick break. Join my free Freedom operating system on School and download the free guide inside. Links in the description and the pinned comment below. Now back to it. Now the #1 retirement killer, remember what I said at the very start? At least one of these is probably in your portfolio right now. This is the one. and nobody warned you about it because it's the one they recommended. Too many bonds too early. First, plain English, a bond is a loan. You lend your money to a government or a company. They pay you a small amount of interest every year, and at the end, they hand your money back. Compared to stocks, the ride is calm. That's why advisors call bonds the safe part of your portfolio. And that's why the standard advice says the older you get, the more your money should shift into them. And this is how it ends up in your portfolio without you ever choosing it. If you have a retirement account through work and you've never touched the settings, odds are it sits in something called a target date fund, a basket that moves your money out of stocks and into bonds as you get closer to retirement age. That shift runs on autopilot, whether it fits your life or not. For somebody retiring at 70, that standard advice mostly holds up. The money has to last maybe 15, 20 years, but you're watching a video about retiring early. If you stop working in your 50s, your money has to keep you alive for 30, maybe 40 years. And over a stretch that long, the word safe flips its meaning. Because remember the quiet word from the ladder, inflation. Prices creep up every year forever, and a bond pays you a small fixed return. Over stretches as long as an early retirement, bond-heavy portfolios have historically trailed inflation badly. The number on your statement holds still while the price of everything around it climbs. On paper, you never lose a dollar. In the real world, you lose what your dollars can buy. So the real risk for an early retiree was never the one they showed you, the scary red chart, the crash. A crash is loud, and markets have historically climbed back from crashes. This leak is silent, and it never gives you your money back. The real risk is slower and much quieter. It's outliving your money. That's the twist, and it's why this one catches even people who've been investing for decades. The choice your advisor calls conservative is the most aggressive bet you can make against your own lifespan. To be clear, bonds are not evil. A cushion of calm money as you get closer to needing it is reasonable. The trap is the dose and the timing. Moving most of your tank into a slow leak decades before the math says you need to. If your money has to carry you for 40 years, most of it has to keep growing for most of those 40. So those are the three leaks: the hype basket, the expensive middleman, and the safe one that quietly loses to inflation. Now let's flip it. What does the research say actually works? Three things, and fair warning, the first two are almost embarrassingly boring. That's the point. Number one, low cost, broad market index funds. Think back to that 92% number. If 9 out of 10 professionals lose to the index over 20 years, then refusing to play the stock picking game beats 9 out of 10 professionals. You don't have to outsmart anyone. You just have to own the list. And you already know exactly what to look for because we defined every word. Broad market means the basket holds the whole market. Hundreds or thousands of companies, not one theme. Low cost means a tiny expense ratio, that yearly fee, down near 0.05%, not 1 or 2. Every major brokerage offers funds like this. Boring on purpose. Boring is what compounds. And one basket can be the whole core. You don't need 12 clever funds. One broad, cheap basket that owns the market already gives you what the industry calls diversification. Your eggs spread across many baskets. Except here, the single basket holds thousands of eggs. Number two, isn't an investment at all. It's a behavior. Remember the behavior gap from leak number one? The fund that earned 7.3, the investors took home 2.4 because they jumped in and out at the wrong moment. The fix is simple and it costs nothing. Automatic monthly contributions. Same amount, same day, every month. Straight into that boring index fund. And then you don't touch it. Morningstar measures this across just about every kind of fund. Investors who move their money around lose about 1.2 percentage points a year to bad timing. 1.2 sounds like a rounding error, but you know by now that small percentages are important. Over a decade, that's roughly 15% of your total returns gone. Not because they picked the wrong fund, because they fidgeted. And the automation is what makes it work, because it takes your hands off the wheel. When the market drops and your stomach drops with it, the transfer goes through anyway. Quietly buying while everything is marked down. The plan keeps working because nobody's asking you to be brave. The tap stays open. The tank keeps filling. If you do one thing from this video tonight, set up one automatic monthly transfer into a broad index fund, even a small one. The amount matters less than the automation. You can raise a number later, but the habit is the machine. And the third one is the one I teased you with at the start. The thing I look at every week now that I'm in my 50s. Undervalued assets with strong financials. In plain English, investments where the numbers underneath, the earnings, the cash, the debt are solid, but the price the market is asking for has been marked down anyway. Quality on a clearance rack. How I actually find these is a whole video on its own. Today, just know that it's the third bucket. Index score, automatic contributions, and a small hunting ground for value. That's the machine. Step back and look at what you're walking away with. 5 words: investment, fund, index, compounding, inflation. 3 leaks the plug: the hype basket, the expensive middleman, and too many bonds too early. And the 3 things that work: own the list, automate the deposits, and keep one small corner for the quality on sale. So no, retiring early is not about finding some genius stock. You plug these 3 quiet leaks and you let the boring stuff compound. That's how I did it. And it's why I get to spend my time the way I want. Now, the worksheet, it asks 3 things: your risk appetite, what you've got invested, and what you put in monthly. And it hands you a mix that fits. I filled mine in so you can see how it works. This is it, 1 page, 3 questions. Then you put in your inputs, amount you currently invested. So add everything up: the 401k, IRA, brokerage, anything else. Then what your contributions are each month. And that's only the automatic ones you have, not the ones that you have inconsistent. Try to put in, even if it's $50 or $100 a month and you're doing that, just put that in. It asks you conservative. If you're conservative, this is your risk appetite. If you want it balanced, you're okay with writing a little bit of up and down and growth, which you need a little bit of a higher tolerance, and it's the more aggressive of the 3. And a little bit of the description here. So conservative, 90 to 100%, broad market index fund. Balanced, 80 to 90% low cost broad market index. And then the growth would have 70, 85%. So if you change any answer, the mix changes with it. It's not to copy me, it's your own answers, it's built to fit you, not to copy me. And here, just a summary, just what's your lane, your risk lane. Then if it's your conservative, then your core target for index should be 90 to 100%. And what's this week's one move? Is it, do this once a year and it'll be, do you change to balance? Then you have to change to the 80 to 90%. If it's also to add to your automatic deposits, then you put that down. And that's it. It's free inside my FOS community on School. Links below. And grab the free FOS guide while you're there. If this saved you from one bad investment, hit the like and subscribe. See you on the next one.